Jay Powell says the Fed has to be careful about exiting too early. Does that mean, in your mind, a taper is off the table?
I think the taper is off the table right now. That's clearly what Powell is indicating. I'm not sure I 100% agree with that because I think we're going to have a very strong economy in the second half of the year. But that's the message from the central bank right now, which is they're going to continue to buy 80 billion of treasuries, 40 billion of mortgages, and keep the foot on the accelerator.
You have a bullish outlook for economic growth. Tell us about it.
Yeah, I think there are a couple underpinnings to our growth outlook. One is, we do a lot of business in Asia, and China is quite strong. You saw exports in China that came out last night for the year. They were actually up year over year, 2.6 trillion. It was a record year, so that's point one. Point two is people are underestimating the savings. The U.S. consumer, the savings rate's about 14% right now. It's about double where we were going into the pandemic. We've seen a huge surge in the savings rate in China as well. And then the third is the fiscal stimulus. We think, based on last night's comments from President-elect Biden, that disposable personal income could be up almost 5% in 2021. And that's on the heels of a recession in 2020 when disposable personal income was up 3%. So there's a lot of firepower in the tank. Obviously, we need to get the vaccine out in a thoughtful way. But this is a recession that's quite different, and the recovery will be quite different too. So, in 2009, 10, and 11, we were worrying about could the economy make it, and that's when QE really took off. Right now, the economy is going to make it. It's going to be strong, and ultimately, from a global perspective, Asia is going to lead us.
Henry, are there policymakers at the Fed who see what you see, who see the potential for an acceleration of growth, and at the same time who are perhaps concerned about the risks of infinite bond buying and debt monetization? And if so, how powerful are their voices at the Fed?
It's a good question. Yeah, ultimately, I think that the Fed is committed to keeping rates low through 2023. I don't think that's on the table. My gut is there's dissension or some discussion about the pace of tapering. I think the taper tantrum obviously created an unsettled capital markets. But let's put things in perspective right now. Real rates are negative 100 basis points. That is an incredibly accommodative situation, right? 2018, right before the pandemic, real rates were positive 100 basis points. So we have a lot more room, in my mind, to maybe not have the foot on the accelerator quite as much on the bond buying. So we'll have to wait and see, and it's certainly something that that I think the Fed will do too. But I think when we get into by the fourth quarter of this year, we're going to have very fast nominal GDP growth. Let me say that again. We're going to have very fast nominal GDP growth. We haven't had that during past recoveries. And so the way you deal with that recovery from a central bank perspective has to be different. And clearly the Fed is taking all these inputs in. From our standpoint, I mean, we own 150 to 200 companies around the world globally. And what we see is an economy that will be poised to grow quite strongly coming into the second half of 2021 and certainly into 2022.
Henry, dollar down was a great trade until just a few days ago. Is the dollar doomed to fall further?
I think the dollar will remain in a downtrend. I don't think it's going to fall as fast as maybe some people want, but it certainly when you look at it relative to the yuan and the euro and the yen, it seems like it's expensive from a real purchasing power perspective. And also, I think given the U.S. is now the center of the spending relative to other countries, it probably argues for further weakness. Remember, in 2009, it was China that put the world on its back in terms of fiscal and monetary stimulus. This time, it's the U.S. The U.S. is about 40% of total fiscal and monetary stimulus of the 29 trillion, which is it's an incredible number to say, but that's where we are globally. The U.S. is about 40% of that, and last night's announcement probably will take that number up.
Henry, financial markets all but ignored the storming of the Capitol building last week, and for that matter, the second Trump impeachment. Is there no negative fallout or, for that matter, macro risk from the deep divisions and persistent tensions in this country?
There will be fallout. I mean, I think what did President-elect Biden start with last night? He talked about, that somewhat a redistribution of wealth. That's point one. So I think probably we should prepare for higher taxes in certain situations. Number two is, and I think this is, the title of our outlook piece, another voice, is ultimately there's a secular shift taking place, which is we think there was a bear market in small cap stocks and in emerging markets that started in 2018. And the day the vaccine was announced, you started to see that shift into those areas. And ultimately, that's quite bullish. And so most people are overweight indexing. Most people are overweight large cap growth stocks. And there's going to be a shift into other parts of the market. And that's true in credit. It's a really good opportunity for people that are thoughtful around portfolio construction. I just point out that Amazon's market cap, I think, is bigger than the Russell 2000. So it doesn't take a lot of movement out to create some significant shifts in value realization, and that's what's going to happen. So every cycle recovery is different. This one, there will, what I mentioned earlier, which is this is going to be stronger growth where we have to decide when it's time to tap on the brakes. Whereas last cycle recovery, 2010, 11, and 12, we had a U.S. downgrade, we had austerity on the table. That's not the playbook. And so there will be sectors that lag. There will be areas that come under greater scrutiny, but there's also a pretty significant opportunity. And I think,
Henry,
from our standpoint, we see quite a few things to do around infrastructure, real estate, and also in the credit markets.
Henry, you make the case in your research for buying tail risk protection. What kinds of black swan events do you see possible?
Look, I think there are two or three things that could go wrong against what is a generally constructive backdrop for the market. One is earnings could disappoint. That's not what our data is suggesting. Almost every one of our indicators is pointing up. And so most the time the sell side misses the operating leverage on the way down and then on the way back up. So that's one thing, but I don't think that's a big risk. The second you mentioned earlier, Erik, which is the dollar. We need to make sure that the dollar doesn't lose its reserve status. And that's something to focus on, and there are ways to hedge against that. And then the third, which is I think we should all be focused on, is can we have rates go up in an orderly fashion? Most metrics would indicate that stocks and credit are expensive on traditional metrics, but you have to adjust for interest rates. And our view at KKR is rates will go up, and that the market probably has been too benign on inflation expectations, but we don't see a rout. And that viewpoint guides the way we think about our asset allocation. I mean, certainly, when we think about private equity, there's still things to do, but we've also been emphasizing a lot of our real assets franchise. And that gives you some protection against potentially higher inflation. And that's infrastructure, real estate, credit, parts of the energy complex. And so Those are big themes for us where we're deploying capital.